Hey everybody, good evening. Hope you're having a very great day. Today I want to talk about something relatively simple and in its rudimentary form. Today we're going to talk about qualified and non-qualified dividends and how they're really taxed. Now, if you were to go and say look this up on the internet, you'll get an article that looks very similar to this. It'll kind of ramble on about capital gains taxes and ordinary and non-ordinary and give you examples and kind of run on. But I think what ends up happening is with all this nonsense and dollar signs and percentages, I think people generally would get lost in something like this. So what I've gone ahead and done is read the article for you and acknowledged how to make it relatively simple. And so what I've done here then is kind of made this simple table here. And this is basically what the video is going to be centered around, is qualified and non-qualified dividends and what exactly it means. So in its simplest form, qualified dividends are better for taxed accounts, meaning if you own something at an individual brokerage account, you prefer what's in that account to be qualified. If all things like dividend yield and what have you are equal. And I have an example here on the right, and I'll show you too in a little bit. Hopefully I don't distract you with it. But in its simplest form, qualified dividends can get taxed up to 20%. 23.6% if you make over $200,000 a year. So basically anybody who is in the lowest two tax brackets get taxed at about 0% for qualified dividends. And then the middle ranges get taxed at about 15%. If you end up making over $200,000 a year, you get the 15% plus 3.5%, so it's about 18.6%. And then the top tax bracket, you get charged that normal 20% plus the 3.6% for couples that make over $250,000 a year or singles that make over $200,000 a year. This is coming from your ordinary companies like Johnson & Johnson, 3M, BP, BHP, you name it, you got it. It's generally who is going to be taxing you at an ordinary rate. Now, companies that are tax exempt have capital gains distributions like your limited master partnerships, real estate investment trusts, and then if you happen to buy and sell a company directly before and after the dividend date, just so you can get the dividend, you'll also get something in your tax forms called non-qualified dividends. And what non-qualified dividends really are you being taxed at your ordinary tax bracket. So if you're in the bottom tax bracket, no matter what, you're going to still pay 10%. But if you're in the very top tax bracket, making over $400,000 a year, you're going to be getting taxed at about 39.6%. And so it basically goes to show that if you have two companies, one of which distributes qualified dividends, one of which distributes non-qualified dividends, you could actually have a case where you're investing in a company that on the surface has a higher dividend yield, but in actuality at the end of the year, your effective dividend ends up being lower with a real estate investment trust or a company that distributes capital gains as distributions. Not saying that that's necessarily the case, but if you have a company that is roughly the same in terms of percentage yield, like 5%, you can sometimes get paid end up paying over 25% more in taxes. And I have that example here on the right. So looking here on the right with this example, I have somebody that makes about $199,000. And what I've done is I've shown that at a dividend yield of about 5%, or end up getting 4.25% in dividends at the end of the year after taxes are paid. Whereas if somebody that earns $199,000 is investing in something like a real estate investment trust or a master limited partnership, they're only going to end up getting about 3.35%. What that actually shows is, and what I put on here on the screen, is you actually end up making 26% or almost 27% more just in this example. Now, it can be even more drastic if you're, say, in the top tax bracket, like earning over $400,000. And what this basically means is, it's not to say that investing in REITs or investing in master limited partnerships are a bad idea. It just means that you should probably keep them in tax advantaged accounts. There are individual retirement accounts, Roth IRAs, 401ks, or anything of the sort where you have a tax advantage account. That is just to allow you to defer some of this. And generally speaking, why this is important is real estate investment trusts, on average, generally pay a higher dividend yield than most ordinary companies. And that's generally because of their tax advantage status. However, what that basically means is, since they're not really paying taxes on the income that real estate investment trusts make, they pass that on to the shareholders, which ends up making it a non-qualified dividend. And that's why the dividends, or that's why the taxes that you end up paying on the non-qualified dividends are higher, specifically for real estate investment trusts. So I hope this video was informative for you, and if you haven't already, please like and subscribe. And if you have any other questions about how taxes may work on dividends, feel free to leave a comment in the comment section down below. One thing I forgot to mention, though, is with this, you can offset some of these taxes that you get on the dividends that you get based off of losses or depreciation from real estate or what have you. So just because you have qualified or non-qualified dividends, you can offset some of these taxes by having things like capital losses, accounting and offsetting some of these losses, or depreciation from real estate. But that's not necessarily something that I know too much about. I'd have to do more research before giving you guys advice on that, or giving you guys any sort of video on that. So, like I said, hopefully this video was useful for you guys. I'll talk to you guys on the next video. Have a great evening.